You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again with Options Bootcamp, the premier options educational program. My name, of course, Mark Longo from theoptionsinsider.com, as well as, of course, from the ever scintillating Options Insider Radio Network. Asking you if you like what you hear. Do keep rating and reviewing. Coming off November, just a banger of a month, the hottest month in our 15-plus year history. Just, I think the technical term is redonkulous for some of the numbers some of these shows are putting up. You guys are really driving up my bandwidth bills. I both thank and don't like you for that. That's a good problem to have. Keep rating and reviewing if you do like what you hear, just like all of our friends have done. You know, we've been focusing on all these different reviews. We forget the international folks all the time. So let's give them some love right now. Just like our 5-star reviewer here, ASDA193DK from Denmark. He says, this is a value, 5 stars value, very much value in this podcast. I'm not far yet in the podcast, but I am studying I think he says master's in finance. So I have a basic understanding. The way you guys describe derivatives are very intuitive and should absolutely be a part of the way you get derivatives knowledge. Good job, guys. Well, thank you, ASDDA193DK. Glad you're learning derivatives over there in Denmark. I always say the Danes and derivatives, they go hand in hand. Joining me on the program today to bask in the glow of that international love all the way from Denmark, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. What did I always tell you between shows? I said, we're huge in Denmark, huge with the Danes. Have I not said that to you a million times, sir?
You have, and I'll tell you what, I was in Denmark, I want to say it was April of this year, so like 6 months ago or so. And my daughter was studying abroad there for a semester. And so we were like, yeah, okay, we're going to go visit. And I didn't know anything about Denmark. I know that Danish films are my favorite. There's some amazing Danish films out there, but I didn't really know, I wasn't going to go to the movies. So I looked up, stuff about Denmark, and what I came across from, I believe it was Food and Wine magazine, is that Denmark was rated the best hot dogs in the world. The best hot dogs.
Was it a poll of solely Danes? We love our hot dogs the best.
So
there you go.
Went there.
One to grow on, as they say out there. Danish hot dog. Maybe while you were there, maybe you met Mr. ASDDA193DK, which maybe that led to the good review, Dan. Maybe you are responsible for our international love affair from Denmark. Either way, we love all of our listeners, foreign and domestic. Keep that love coming. Speaking of keeping the love coming, it's time for us to give some love back. Mr. Dan, you did such a good job last time. I'm going to let you do it again. Are you ready, sir, to pick the winner of our Pro Trading Crate for the month of November, sir? You got it in your bones? You feeling good?
I'm feeling good.
All right, let me just fire up the random number generator. This, of course, listeners, is the grand prize for our pro members over there, theoptionsinsider.com/pro. I know a lot of you came in during the holiday week there to join the party. If you did, you are automatically entered, as well as everyone else who was active for the month of November, a banger month, if ever there was one on the network. So your name is automatically entered in the hat to win a fabulous pro, a custom one-off Options Insider Pro Trading Crate. I'm looking at a mountain of cool goods. We're going to squeeze as many as we can into the crate, including some, you guys get to choose some gear and some educational content. We get to design the rest for you. It's pretty fun. If you want to see what's in them, follow us on Twitter. You see a bunch of our previous winners tweeting it out, all the gear that they get out there. All right, Dan, I bought you some time. If you are now ready, the random number generator is going. Are you ready to pick our winner for the Pro Trading Crate for this month, sir?
I'm ready. Let's do it. Ready? One, round and round she goes. Where she stops, nobody knows. No whammies, no whammies. Stop.
Okay, there you go. Big money, no whammies. Remember that show? That was great. All right. We've got, who is this number? Let's see. Let me put it into our list here. This is Ravi Brewster. Congratulations, Ravi Brewster. You are the winner of our Pro Trading Crate. Look for an email or maybe a DM if you're on Twitter from our producers out there. They will follow up with you, Ravi, looking for your size and your educational preference. We have a whole bunch of great options, educational tomes that you can choose from, including perhaps, if we still have some left, the ones from Mr. P. And then we will put the rest together for you, ship it out to you, and it will be a fun little surprise. Not that little, actually, hanging out on your doorstep. If you want to join Ravi and everybody else tweeting away about these fun, literally our hosts are mad about it now. The Rock Lobsters give me a hard time. I want a box too. Only the cool kids in the club can get it. Theoptionsinsider.com/pro is the place to go to learn more. As we keep on going, Dan is champing at the bit. He's been dying to talk about this. Let's get to it now. A little bit of the old options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All the way from the shores of Tripoli to the options drills. Yes, welcome to this segment, the portion of the show where we break down some options technique or strategy and maybe explain how you can utilize it with some interesting use cases and perhaps some pro tips in your own portfolio. And today we're going to mix it up. We've talked about time spreads before many times. And if you're intrigued by time spreads, I know whenever I mention the word time spread, it just seems like the mailbag lights up and people write in. I know these are confusing things. I get it. That's why we've devoted many episodes to it. So before you go any farther, listeners, with your question, make sure you check the archives. There are a literal legion of episodes devoted to time spreads you can go sink your teeth into. So check those out if you have questions. But we are going to talk about those, also about a different direction, pun intended, that we're going to go into now, because Dan kind of hinted at, if you listened to the show last week, you know, Dan hinted at what he's been talking about over there at MTM. Really quickly, quick refresher now what we're talking about. You know, we have new listeners all the time. We had a bazillion new listeners just last month coming into the network. So quick refresher on time spreads. Of course, your traditional time spread. What are you doing? Usually you're going out, let's say 2 months, and we'll just keep it monthly for now. You can do these in the weeklies or anywhere else. And a lot of people are doing them in the dailies now, even with SPX, but that's a different conversation entirely. Maybe we need a whole show about the explosion of daily options, too. That could be another show, Dan. So keep that in the memory banks. But traditional time spread or calendar spread, as they're known. Go out, let's say 2 months. You're going to buy that at the money call. Let's keep it to the calls. And then we're going to go back to the front month, I should say, and sell that at the money call. And now, let's say in our example, you paid $2 for the 2 month out call. You sold the front month call for $1. So you net paid $1 for that spread. Why would you do this? A bunch of different reasons. One of the primary reasons people do these kind of things is, remember, you're short that front contract. So you don't want that underlying to really go crazy. And that's usually a scenario people approach time spreads from, where they think, you know, I don't think this underlying is going to really do a lot over the course of, let's say, this next month. So it's a cheap time to maybe put on this time spread. There's also different discrepancies in the term structure you want to take advantage of. A lot of different reasons why you might do that. But for a lot of the people listening to this show, the basic retail, one of the most common use cases for time spreads is because you don't think the underlying is going to do a heck of a lot over that time, and you can put on maybe some cheap time spreads and take advantage of that. Let's say XYZ is trading $20. You think it's going to hang out maybe around there for the next month or so. You go out 2 months, you buy the 2 month 20 strike call, pay $2, turn around, you sell the front month, the 1 month at the money call. You sell it for $1. So in our example, you paid net $1. That is your net risk for the spread. The most you can lose on the spread is $1. So that's kind of nice. You're defined at the outset what your risk is. XYZ, of course, closes below 20 at expiration. On that front month expiration we're talking. Remember, you have 2 expirations, which always blows people's mind. We're just going to focus on the front month expiration for now. If it closes below 20 at expiration, that call expires worthless. Now you got that second month call for $1 sitting there. You can do a lot of different things with that. If it goes above 20 at expiration, that's where things get a little dicey. Then, of course, you effectively now have a long call 2 months out, or now 1 month out because the front month is expiring. And you also have a short stock position from the front month. So that's usually why we tell people that's obviously a synthetic long put. That's usually when we tell people to close these spreads out before those kind of things can happen, before you get that stock leg put to you. But there's a lot of different things, a lot of different moving parts with time spreads, which makes them fascinating, again, which is why we've devoted many different episodes to them. There's your basic refresher for all you newcomers, all you legion who've come in over the last month. But Dan, the table is set now, so I know you've been just eager to dive into these quote unquote directional time spreads. So have at it, sir. The floor is yours. What the heck are we talking about? What the heck is a directional time spread, sir?
All right. So look, the thing to keep in mind about time spreads, when you're doing a neutral one, like Mark was talking about, what you want is you want the stock to be at the shared strike price at expiration. And, I always model out my trades when I put them on. Like I'll, if it's a spread or something, on my Thinkorswim, I'll go to risk. I always start in the analyze tab and I go to risk profile and just see what the picture looks like. Right. And so there was one today. Those of you who are our regular listeners know that I recently created this credit spread genius and time spread genius system where these trades, like if a professional trades one of these, it pops up. And one popped up today in a stock called MPW. Okay. So MPW is Medical Properties Trust, Inc. And I don't know what the heck they do. I know that they've got about 13.5% short interest, but they do make money. They have a 5.6 PE ratio. The stock's trading at about 11.79 as we are recording this.
This one's come up on our option block radar, I think. I think it's a REIT.
Oh.
It's a REIT that invests in medical and healthcare facilities.
Oh, yeah. Okay. Interesting. So, so when a stock has more than 15% short interest, which this is just shy of, and they make money, I look at it as a short squeeze candidate. So this may kind of be that also, but it's kind of sort of turning down here, with the market and just with the pessimism on real estate. So the spread that turned up, with the stock here at like 11.80-ish is the regular January 11 strike put spread. So that's like, 9% out of the money, south of the money, right? So if you're sitting in front of your trading platform as you're listening to this, model that sucker out, MPW. And you'll see that at like the best place for this to be at December expiration, which is 8 days from now. It's the 16th. 8 days from now? No, 9 days from now, the 16th. It's at 11. It's at that shared strike price. So this is clearly a bearish play. And so why, the question becomes, why did they choose to play it this way? And before I created Time Spread Genius, like I didn't realize how much that I was going to, like all these aha moments that I would have about trading. Because I've traded time spreads, directional time spreads, like thousands of them over the past 30 years, But I guess I have a newfound appreciation for these directional time spreads, because if you model it out right now with the stock at 11.79, if it goes down to $11, you more than double your money, right? If it's like exactly right there in the perfect spot at the perfect time, which, you know, with any time spread, we're never expecting that. You just want to get kind of close to 11. But even if it doesn't go down at all, you still make money, and you double your money if it doesn't move. You like almost quadruple your money if it gets to 11. And that is the magic of directional time spreads. Because if I'm bearish on this thing, I could go and I could just buy, you know, like December 16th is the expiration, obviously the expiration that we're looking at here. I could go and buy the 11.5 puts for 35 cents. But even if we go down to 11.5 by December 16th, I'll lose my entire 35 cents. I've got to go down not just to 11.5, but 11.5 minus the 35 cents that I pay for it. Or what I just did, you guys might have heard while Mark was talking just before we got on when he was explaining time spreads, you probably heard my think or swim little noise go up. Well, I paid 35 cents for that time spread. I paid the same that I would pay for like the 11.5 puts, but the 11.5 puts would literally really have to overshoot my target of 11 in order to have the risk reward even remotely make sense. If I buy the puts, it goes up, I lose. If it stays where it is, I lose. If it goes down a little, I lose. It has to go down a lot. This time spread, oh my goodness. Like I wish we had video here, Mark, because, you know, I'm just looking at it and
they can see how giddy you are right now.
I know, man. Like even if it go like the upside break even on this time spread is about 12.25. So, I mean, it can even go up. I mean, that's kind of a lot, actually. I mean, it's like almost 50 cents from where it is now, 45 cents from where it is now on an $11 stock. I mean, that's, 4% or something, right? 11.8 or, yeah, it's so that is the power of directional time spreads, is you can be wrong and still make money.
These REITs have been a very beaten up sector for very obvious reasons. If you listen to our option block show, we talked about a lot of puts. Also, our options oddities, our pro show, we talked about a lot of puts going up across the gamut of REITs out there. We just talked about some recently for size out there. And MPW has come up in the past. I'm looking at the chart of it right now. It was trading $22 a year ago. Listeners, it's trading $11.79 right now. It did hit a low of $9.90 recently. That was back in October 10th. So it has rebounded almost $2 from that low, but still obviously well off, nearly 50% sell off here on the year. So Dan, when you're talking about directional time spreads, it's taking what we talked about earlier, that at the money approach, which is the way people usually approach time spreads when they're first coming to it. And now you're shifting it a little bit. You're shifting it out of the money, either in this case, south, as you like to say, with the puts, or a little bit north with the calls. You have some call directional time spreads you're doing as well?
Yeah, when they pop up. Well, I mean, look, like I trade these with the Time Spread Genius, but I also trade them, just on my own when I see them come up. And like one of the things, and I've mentioned this, for you guys who have been long-term listeners, you've heard me say this a bunch of times. I tell all our students to always look for 3 different ways to trade an opportunity and pick the best way. And how do you know which is the best way? Well, model it out and just like look at it and like see which one makes the most sense. Like you can kind of feel your way around in the dark a little bit. And if you just try to pick the best one, you're going to arrive at it more often than not. So, I mean, if I'm bearish on this, like I expect this as a REIT to continue falling and kind of fading any potential short squeeze here, and I think it's going to drift down lower over the next 9 days, how do I trade it? Well, the put's obviously a terrible idea. Could I sell a call credit spread? I mean, it's only an $11 stock. How much are you going to get for a call credit spread? I can pull it up here. What are you going to sell? You could be super aggressive and sell the 12 and a half spread, but I mean, that's 25 cents away from the money. You're wrong there. You can end up in a lot more trouble, right? You could buy a put spread so that you could hedge off some of the time decay risk and that kind of thing, but this is like one of those new tools in your toolbox. This is one of those new things that if you've been listening to the show for a while and you've gotten a good feel for options, that you should start looking at when it comes to your directional trades. And it's not always going to be the best way to trade it. I suspect that one of the reasons it's the best way to trade it here is because the volatility of the December options is 74, where the volatility of the January options is 56.5. So kind of a big difference there.
That gets back to what we were saying earlier, listeners, about term structure. Term structure, obviously, the comparative levels of vol in each of the expiration cycles. And you can use time spreads to trade the discrepancies therein, which is intriguing. Dan, it sounds like you're making converts to some of our listeners. We got Nichols in the chat saying he likes it. Option God in the chat saying, I've never traded a put time spread before. Maybe I should consider these. So there you go, Dan. You're luring folks to the dark side of your directional time spreads as we speak, sir.
Yeah, well, what's funny? This is so crazy, man. Like, I first came up with Credit Spread Genius, and that one's very straightforward. And, obviously their credit spreads produces a high percentage of winning trades. But time spread, I was just like, well, time spreads are sort of the, like the two mother strategies of all option trading are verticals and time spreads, right? Almost everything else is a derivative of one or both of those. So, except straddles. So I was like, well, yeah, I'll just do time spreads too. And I figured that it would generate a bunch of neutral time spreads, like where the strike is close to the stock price.
That's the normal assumption with time spreads, right?
Yeah, that's the normal assumption. But there's actually there's actually four types of time spreads, but there's three that mainly pop up there. One, of course, is the neutral one, and like a bunch popped up in AT&T today, NVIDIA, neutral time spreads. And then we get these directional time spreads. And like, if you've never traded it before, like, don't be intimidated. Like, just model a couple out. You don't even have to trade them. Just model out and see what they look like. But the big, like, magic secret is you want the stock to be at the strike at expiration. So wherever your target is, because we always want to have a target when we're forecasting, wherever your target is where you pick your strike. That stock was at 1180, pick the strike at 11. But then the third type of calendar spread that pops up there is a roll. Like when somebody is long some calls or puts, and it becomes apparent that it's a roll when if there's an open interest in the front one that they're selling of like 1,000 and 1,000 trade. And then in the month that they're buying, there was open interest of 0 and 1,000 trade. It's like, oh, okay, this person is obviously just rolling this forward. It's not really a time spread for me to follow along with and trade. If anything, if they're calls, he's selling the short-term calls that are about to expire and rolling it out to get an extra week or month or whatever. And so then you analyze it and decide whether or not you want to make the directional trade.
Let me ask you this, because there are many different moving parts in a time spread, as I alluded to at the top of the show. One of the ways new time spread traders tend to sometimes encounter trouble is they don't know what to do with it once they put it on, because there are two different moving parts. You have two different expirations. A lot of different things can go wrong during that time frame. So let's say in this example, Dan, let's walk it forward a little bit for our listeners. You have this 11 put spread. You're long, obviously 11 puts in one cycle, short in the other. Let's say in our example, we get to that front contract expiration and we're still hanging out here at around 1180. Haven't gotten to that 11 strike. What would you do in that scenario? Would you let the 11 put go out worthless? Would you keep the long put, or would you take the whole thing off? And then let's workshop it a little bit more. What if we drop down to below the 11 handle? What are your scenarios there, sir?
Well, 9 times out of 10, what I'm going to do is I'm going to close the whole spread as a unit. This one, I just like, because of the massive high probability of success here. If we get to expiration day and, like I can take a little bit of profit out of it, 9 times out of 10, I'm going to close it. But, I'll probably look at it with another week's worth of information and dig into it, not just trade it as, oh, hey, this is a massively high probability trade, but, really look into it a little bit more. And the nice thing about this MPW trade is that it does have weeklies. So I could roll it out to December 23rd, then to December 30th, January 6th, January 13th, and I can just milk the living crap out of it. Because I bought the January 11 puts at 55 cents and sold the December ones at 20 cents. So if next week I can go and get another 20 cents and the week after I can get another 20 cents, I mean, now I'm in a no-lose situation and everything I sell is just extra gravy. And if we're closer to the strike, I'll be able to sell those short-term puts for more than 20 cents, maybe 30 cents, maybe 40 cents. And now I put myself into this just massively great situation.
There you go, listeners. The options 201, sometimes I say the options 301 time spreads. Now we're adding an angle to it. Now we're adding a direction to it. So hopefully that didn't blow your mind. But it is an interesting idea. Again, everyone always approaches time spreads the way I did at the outset, which is effectively the directional neutral approach. But this is an intriguing one, getting a little bit out of the money in either direction and how that influences the overall trade. It's interesting. I have a feeling we'll be coming back to this one as well. I'm sure once a lot of you listen to this and start mulling it over and maybe start modeling it out, let's look back at this one again, listeners. This MPW's Medical Properties Trust. It's an intriguing one with it around 1180 right now. What are you folks thinking out there? Is this an underlying, you would be intrigued by that trade? Are there other ways you'd like to set it up? This also goes back to what we were saying before earlier about the challenges of making money with puts in this environment. You usually have to have some other short leg against it. In this case, it's a directional time spread. Intriguing stuff. I think we will return to this as we keep on rolling. Let's get to some of you folks now. It's time for a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. Welcome to the mail call, the portion of the show where you folks take the reins, your questions, your comments. We also pay off your thoughts on some recent hot issues in the world of options. We asked you folks last week. We've seen volatility erode in recent weeks. Have we entered a new VIX regime, or is this just a blip on the radar? Quite simply, where will VIX close at the end of the year? When we asked you this last week, it was about exactly a month out. Gave you 4 choices around where it was when we posted this poll. So between 20 and 23, obviously, if you've been following vol, VIX dipped into the teens. We got into an 18 handle ever so briefly. Then we higher than that. So a little bit north of 23 to 26 or north of 26 or in the teens again below 20 on the close for the year, listeners. And with nearly 35% of the vote, 34.8%, you said pretty much around here, 20 to 23 range is where you expect us to be at the end of the year. 29% for number 2 saying between 23.01 and 26. 18.8% saying north of 26. So you expect a little more vol to creep in towards the end of the year, which is always a challenge with that seasonality, but not impossible. And then for those folks loving the teens below 20, 17.4%. Dan, does that surprise you, or is that pretty much what you expected, sir?
I would say, it's so easy to say going in hindsight, but if I'm not mistaken, the last time we talked about this, I was voting for that 23 to 26% range, back then. And so have we entered a new VIX regime, or is it a blip on the radar? I think back when we were below this, it was a blip on the radar. I think we're still in the same regime that we've been in for a while. I think it was just an anomaly when we're below it. And, like the daily video that I send out to our followers at Market Taker, I send out a daily video every early evening. When we were right around 20, I said, hey, this is like a put buying opportunity to hedge your long-term portfolio, which is what I did at that time, not my full portfolio, but some of it, because why wouldn't you? Like, none of our problems are different than they really used to be. You get a smidge of what's kind of like less bad news, and people buy up the market like it's going crazy, and vol collapses. It's like, I mean, nobody can predict the future. I never know what's going to happen, but geez Louise, I mean, how do you not think that the market's not going to pull back and vol's going to go up, So yeah, I think we're back to what is the new normal for a while.
Yeah, we are back into that range right now, hanging out about 22 3/4 right now in VIX as we're recording the show, listeners. So back in that range after our brief dalliance with an 18 handle. Our question of the week this week, listeners, what is your favorite new, we put new in quotes because one of these at least launched at the end of last year, but new option product that you've added to your trading arsenal this year? Gave you 3 choices and the infamous other, BITO options, which you've talked about on the show before. These new just crazy SPX daily options everyone seems to be obsessed with. And a bunch of our new vol ETF friends, SVIX, UVIX, SPKY, etc., and so on and so forth. Or other. And if you have an other, we want to hear what it is. Mr. P, sir, first off, what is your vote and what do you think our audience is voting for?
Well, I mean, for me, it's the daily options. Well, actually, really, I don't typically trade SPX. I've been doing the SPY ones that are, well, I guess those are daily, aren't they? Yeah, I've been doing the SPY daily ones, and I do a lot of those. Some of those volatility ones I'll watch, but I don't trade them that often. And I look at BITO. I was just looking at BITO yesterday. So that's it for me, just the dailies.
It's like whenever I walk into your mastermind sessions, you guys always have BITO up on the screen. So I know you're a BITO lover out there. And BITO ran away with it early. And now, as I kind of expected, the dailies are running away with it, Dan. 69.6% saying SPX daily options. Only 17.4% for BITO. So we had a huge surge in daily love just in the last day or so. And then only 8.7% for the vol ETPs out there. Only 4.3% for other. No good others sent in yet. If you have an other, send in what your other is. We want to maybe discuss it on the show if it's intriguing out there. Speaking of discussing things on the show, Dan, folks are hitting you up day in, day out with questions. What is the hot, the cool, the biting topic? What is the MTM question of the week, sir?
Mark, somebody was asking me just a little bit ago about if covered calls make good directional trades. And, there's a lot to discuss with that question. And it sort of got me thinking. And I'm actually relaunching our MTM Smart Income System, which is all about covered calls. We're actually having a webinar on it on Saturday, which if you want to join us, I'll tell you how you can attend that for free later. But the answer is kind of yes. Most of the time when I have on a covered call, I always leave some room for the upside. I mean, it's a positive delta trade. It's just that the profit potential is limited. Like if the stock goes up too much, you stop profiting. So I like to trade. I do think of them as a bullish directional trade, but a slightly bullish directional trade. If I was screaming bullish, I would just go buy some out of the money calls and forget about the stock. I typically, when I do covered calls, I typically do them on stocks that I currently own that I'm not selling, which means I'm bullish by definition, but I think that they probably have some resistance to the upside, like maybe literally on the chart, or just, or there's some reason to feel like they'll be held back, just limited upside move. So, yeah, I guess the answer to that question that was put to me is sure, they're definitely directional trades, bullish directional trades, but just, they just have for limited moves.
Yeah, if you ask Matt, who's been on this show a couple of times now, he says, all their back testing shows the lion's share of anything you're going to make, obviously, out of covered calls, always the directional move in the stock. The covered call is a sweetener on top, right? It's a little bit of extra income when you don't get that. But the big kicker for any of your covered call positions is that underlying portion, listeners. So bear that in mind. In fact, he started adjusting all of his covered calls now to pretty far out of the money because that's where he sees the lion's share of the profits, which is intriguing. Let's get on out to this one, Dan. We got a question. Actually, this is kind of an update for our listener from last week. What was their name? It was Elsewheres with a Z. They asked last week, is this still a record year for options trading, or have most of the newcomers lost their money and left the market? And we said last week the answer was yes, but we were just on the cusp, just about to get the numbers from our friends at OCC. We were like a day away from it. As you recall, listeners, I didn't expect November to be a rock'em sock'em robots month. We had some big days in there, obviously, but also it's a holiday month. People are traveling. The Thanksgiving holiday week is usually notoriously thin and light from a volume perspective. So didn't expect November to be a rock'em sock'em month. I didn't even think it would really make it north of 900 million. And I was wrong, Mr. P. November, a banger month, 922 million contracts, the third highest month in the history of the options business. So that trend of every month this year being somewhere in the top 3, if not the top 5 in history, continues with November. Also saw average daily volume, which is an important number, listeners. That'll tell us if we're going to beat last year or not, is 41.3 million contracts. That's still up nearly 5% from what it was this time last year, listeners. So Elsewheres, who wrote in, and everyone else, the answer, yes, Dan. November, a banger month, 922 million contracts. Does that surprise you? Even with the holidays and the half days and everything else, we still managed to put up a top 3 month, sir.
Yeah. Honestly, it does surprise me a little bit, but it makes me happy because it just means that traders and investors are getting smarter, and they're using this amazing risk management tool. And it's great. The traders and investors are much more sophisticated than they have been in the past. I love it.
Speaking of amazing risk management tools, or perhaps not, we'll get out of here on this one. This comes from NKZ. He wants to know, or perhaps she, does Mark or Dan think the Nanos are a good product for new options traders? The Nanos. We just had our buddy, Mr. Flowmaster, a.k.a. Henry Schwartz from Trade Alert, now over there at SIBO. He's pretty much Mr. Nanos. He's one of the guys that helped create them and usher them into existence. He's still one of the few people out there who actually trades them. And even he's a little reticent to recommend them for new traders for a variety of reasons, NKZ. The first is that with any new product, what you really need is volume and liquidity, right? And if you don't have that, it's kind of hard to recommend any product. And we don't really see that yet in the Nanos. The volume, the liquidity, and as a result, the spreads just aren't there yet. It's very much a trade by appointment type product. And it's also limited. They pretty much have it in the S now. Obviously, SIBO wants to promote that product. I think it would be much more intriguing, I think, for a lot of our listeners of this show if they started putting it out on some single name, like, let's say, your Apples and your Teslas and all the other names you folks like to trade out there. I think that might actually get a lot of the quote-unquote meme and the Robinhood crowd that they're targeting with this product, get them a little bit more interested. Not a lot of them slinging SPX. I get it. This makes SPX more attractive, and they want to drive people to their proprietary product. I get that, but maybe that'll help drive a little bit more paper. But right now, NKZ, unfortunately, I can't recommend them. There's just not enough there yet. It's unless you really want to trade by appointment and put on a trade that's you're just going to have to carry it to expiration, and otherwise you have a lot of slippage going back and forth. It's just not there yet. I'm not sure if it will get there, quite frankly. I don't know if there's as much demand for these one-to-one. Remember, the Nanos listeners are options with no leverage. So the entire concept of leverage, which is one of the pivotal selling points of options, is now gone with Nanos. It's pretty much one-to-one, one share, one contract. So it's simple. It's low cost. That makes them attractive to a certain audience out there. But right now, the liquidity isn't there. The volume isn't there. The spreads are still too wide. So I would say if you're intrigued, wait a little bit. And we'll see. Maybe if they take off, you can certainly dive in. In the meantime, the dailies, if your SPX is your thing, the dailies are a pretty low-cost way to kind of do the same thing with a little bit of limited exposure, limited outlay. Mr. Dan, what are your thoughts here as NKZ wants to know? Do you think Nanos are a good product for new options traders?
Well, yeah, I think they potentially are, but, like you're alluding to, Is the liquidity there? And to be honest, I can't answer that question because I don't have a resource to even access them. I imagine if I dug hard, maybe they're online somewhere with a 15-minute delay, but Thinkorswim doesn't allow for them. I can't even see them. So it's unfortunate because in theory, the answer is, yeah, they're great. You should definitely be doing that if you're a new person. But if the bid ask spreads are super wide, then you're just in your learning process, you're training yourself to lose, and you're giving yourself a pretty bad experience and hurting your confidence. The thing with, what a lot of people don't realize with any new financial products like this for the public is like there are a few different parties involved and everybody's got to be on board. The exchange that lists them, the brokerage firms that make them available to the public, the liquidity providers, the market makers, and then people to actually trade them. And if any one part of it is missing from that little ecosystem, it don't work. So, it's kind of unfortunate. I mean, somebody needs to nurture these things in order for them to take off. And I guess they're just not being nurtured.
Yeah, we're big fans of new products here, especially ones that make options more accessible to you retail folks out there, listeners. But unfortunately, no one wants to be the first person to the party. And that's kind of what you are right now if you dive into options. Let more people get there. Let the music start playing before you dive in to the party there, listeners. Otherwise, in this example, it could end up being costly for you. But we'll keep an eye on them. We have been, NKZ. And if we start seeing more paper, more interest, more liquidity, tighter spreads, we'll be sure to talk about them here on the show. Dan, that music means we are done for this week. Remember, listeners, if you guys have questions about any of the stuff we talked about on this show, or maybe something you just encountered out there in your options trading, you're new to these markets, maybe new to the show, like, what the heck is this? What happened to my position here? What should I do in this scenario? Hit us up. Let us know. We'd like to hear from you folks. You guys are literally the reason that we do this show after all. Mr. Dan, if folks want to reach out to you, where should they go? What should they do?
Well, make your way on over to markettaker.com. And, if you want to attend my webinar this Saturday, which is on covered calls, I think I might touch on cash secured puts. It's complimentary. Go to markettaker.com/REG, as in like register, REG, and be my guest, quite literally. And I'm going to have a really nice presentation that explains how covered calls work.
I'll only go if you sing Be Our Guest when I sign up. Then I'll down for it. You do a little Beauty and the Beast solo for me, I'm in. What do you say? Can we do that?
Mark, I'm not as familiar with the Disney princess songs as you are. I know,
Technically, that was Lumiere the Candlestick. The late great, I'm forgetting his name. The guy used to be in Law and Order, but he was a good, big Broadway guy. But yes, if you can hit me with that one, sir, maybe I will go to /reg and sign up. Check it out for yourselves, listeners. Market Taker, 2tsinarrow.com is the place to go to begin your journey. And if you're in our pro club, listeners, don't worry. Your journey has just begun. I'll be back in a few minutes now with our buddy, the once future and now present Mr. Dr. Bix, a.k.a. Russell Rhodes, to answer all of your questions. I'm sure you have a legion. Everyone does. But what's going on in the vol space right now? What's going on with VIX? Why is it doing X? Why is it doing Y? Why didn't it do Z? All sorts of fun and a whole bunch more. That's coming up over there in just a few minutes after this. If you want to check that out on the Pro Podcast feed, join us for Options Oddities, other exclusive great Q&A sessions, and of course, get your name in the hat for the giveaways. Join us live for this show, everything else we do, all sorts of fun. It all begins theoptionsinsider.com/pro. Then we'll see you back here next week, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.